The growing presence of private equity firms in the insurance industry is the subject of a new AM Best research report. Over the past decade alone, private equity-owned or sponsored insurers' admitted assets grew to $604.1 billion in 2020. That's up from just $67.4 billion in 2011. I'm John Weber for AM Best TV, and I'm speaking today to two analysts to discuss some of the findings from the report. Senior Director Tom Rosendale and Industry Research Analyst Brian Kelleher. And Tom, let's start with you. What's been the key driver behind this growing role for private equity, particularly in the life annuity segment?
Well, John, we have a situation where the conditions are quite attractive on both ends of this of these deals, both from the standpoint of the seller as well as the buyer. So, from the standpoint of the buyer, many of these companies that are looking to offload some of their fixed annuity business, particularly fixed indexed and fixed deferred annuities, are finding the interest rate environment unattractive to them. Many of them participate in the annuity business not as a primary line or core line of business, and often don't have the appetite for the type of investment risk or the investment expertise to manage through the spread compression in this environment. And of course, the environment got even more unattractive from that perspective as we entered the pandemic, and we saw a drop in the 10-year Treasury. And as we stand today, the 10-year Treasury is running, I think, about 1.29% right before we get on to do this video shoot. So so things are difficult from that perspective, and so a lot of companies who don't view those lines of business as core to their business models are finding, as they do their ERM analyses, that that it makes sense to unload some of this business or offload some of this business, both in terms of block transactions and in terms of flow business. If they're still writing that business, they may choose to enter into a reinsurance agreement to allow for that some portion or all of that business to get reinsured as they write it. So if you flip over to the to the demand side or to the buyer side of this equation, we see a lot of new entrants coming in, and private equity, often paired with asset management expertise. Either they have an asset manager in-house or they partner with an asset manager that has particular areas of expertise, primarily in the fixed income space, oftentimes structured securities or other asset-backed securities. They're finding, that they can reconfigure the investment portfolios associated with these liabilities and get a much more attractive spread. So I think that's created the environment where it's attractive to reinsure this business. And as we've seen a number of companies enter this space, it's getting somewhat competitive. And we're even seeing some of the appetite grow beyond the standard fixed deferred annuity and fixed index annuity space, and we're seeing some interest in variable annuities, immediate annuities, structured settlements, and so forth.
Brian, what kind of operational or asset changes tend to occur once an insurer comes under private equity ownership?
One of the most notable changes that have occurred takes place in the bond portfolio, with an increased exposure to other asset-backed securities, which encompasses mostly collateralized loan obligations. We found by the end of the third year, nearly 55% of the PE insurers we identified doubled their dollar value exposure in the asset class, mostly in private. We also saw increased reinsurance, with more premium being ceded, most of it going to Bermuda in recent years and large majority to affiliates. In addition, we also saw increased capital within the first couple years with the use of capital infusions, which also has led to increased RBCs for these insurers within the first couple years of ownership.
Brian, how have private equity-owned insurers performed compared with the broader industry?
Compared to the life and annuity industry, the PE insurers have had a higher net yield since 2016, performing better in different asset classes such as scheduled BA, common stocks, and they also having a lower expense ratio. And when you look at how these insurers are getting the extra yield, their bond portfolio leads heavily towards private placements, with 50% of their portfolio in private placements over the last 2 years, compared to just 37% for the life and annuity industry in 2020. And these private placements are offered cheaper and and offer better returns than public bonds. And these companies are less concerned about the less liquid nature of the private placement, but want to earn the extra yield. In addition, since 2010, these PE insurers have held double the allocation of cash and short-term investments, around 6%, compared to the life and annuity industry.
So, Tom, what are some of the rating considerations that come into play when these companies enter the market?
Well, there are a few, John. As many of your viewers may know, our ratings are centered around our assessments of four primary building blocks of the rating, including the balance sheet strength, operating performance, the business profile, and enterprise risk management. So when you think of it from that perspective, many of these new entrants to the market are coming in without an established business profile, right? They don't have a book of business coming in. So we're rating them kind of out of the box without a business profile. They have no operating performance history, so that presents a bit of a challenge. We do have a specialty rating criteria entitled new company formations or rating new company formations, and that does inform us a bit in terms of how we approach the challenges around assessing operating performance and business profile for these new companies. But it does provide some limitations, right? Out of the box, it's difficult to achieve the same rating level without an established business profile or operating performance history.
Thanks, Tom. Brian?
Thanks, John.
Thanks, John.
That was Senior Director Tom Rosendale and Industry Research Analyst Brian Kelleher. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.